Hi guys, Max here, and this is your daily market update for yesterday, the 27th of December. Markets were back open, of course, news was flowing, and we've got a fair bit to talk about today, so let's just get right into it. So obviously, US stocks were at all-time highs again after fears from the Omicron variant, tapering from the Fed, and interest rate hikes have all been lowering. Basically, all losses over the last month have been erased, and we're back at all-time highs for US stocks. Of course, the Nasdaq did well, but not nearly well enough to erase most of the tech companies' yearly losses. The index as a whole is up, of course, but the Nasdaq is still being carried by those top 5 stocks, the Teslas of the index, which have risen ridiculous amounts over this last year, as all the other tech companies on the Nasdaq, companies like DocuSign and Zillow, have been crashing all year long. Now, in Europe, we see the same sort of story. Again, solid, consistent rises as the fears from the Omicron variant have been decreasing, as deaths are staying pretty low despite the fact that cases are rising very rapidly, which is obviously good news to hear. In Asia, once again, a similar story. Most Asian stocks have been rising, along with emerging markets as well, but Hong Kong in particular hasn't been rising due to fears surrounding China and the CCP and their regulatory crackdowns being long from over. In short, markets all over the world are rallying after more certainty regarding the Omicron variant. Fears are disappearing, chances of restrictions being implemented by various governments are reducing, and markets are rallying on this new added certainty that actually everything's going to be alright despite the Omicron variant. With regards to currencies, there hasn't really been any changes, except of course with the Turkish lira, which fell again after actually rising the week prior, but it's pretty much erased all of those gains it used to have, so it's still a very bad situation. Just take a look at a chart of the lira versus the dollar over the last year, and you'll see exactly what we're talking about. Oil prices are sitting at just about $79 a barrel again, rising back up to post-pandemic highs. Of course, this makes perfect sense. There are less fears for demand being impacted by Omicron, which means oil is going to keep being needed, it's going to keep demand high, prices are going to stay high. This all makes perfect sense, and it was actually perfectly expected as well, no surprise here. In terms of crypto, well, it's holding that same sort of position over the last few weeks. Bitcoin is sitting just below $50,000, Ethereum sitting just below $4,000. There haven't really been many changes, although there have been a lot of positive and negative 5% days, but the support for this price level just seems to be a bit too strong right now. We're not really seeing any kind of real movement. Now, there is actually a fair amount of Chinese news today, so let's get right into it. First, of course, we're looking back again at Evergrande, the most indebted property developer in the world, and they have more bond payments to make, but of course, they're not going to. The company has already defaulted on bond payments in the past. They have failed to make these payments. They are already in default. They are already bankrupt. And then on top of that, they've got another $255 million due to pay this week. And it's very unlikely that they will pay. It would be very surprising if they do. Evergrande is still refusing to comment on this situation at all. They've just turned off their phones and buried their heads in the sand, and they're just pretending that this isn't happening. There is, of course, a debt restructuring plan in progress with the help of the CCP, but unless the company is nationalized or unless the debt is absorbed by the CCP or it's just deleted, then this is really going to be too little too late. Interest rates for junk companies in China are really high, which means that this debt restructuring would make their liabilities harder to fulfill, not easier. All it would really do is kick the can down the road. It would just delay Evergrande's eventual final collapse another 6 months, a year, maybe 2 years max. It doesn't change any of the real problems here. No, Evergrande is just a dead man walking at this point. I've been saying it for months. Mainstream media has finally caught on and realized the reality that is the Chinese economy today. Now, with that being said, there are some other developments from China as well, and they have created new rules for foreign IPOs in the wake of the DiDi IPO about 6 months ago now. Now, some industries have been banned from foreign IPOs altogether, and these companies banned aren't allowed to sell foreign shares to foreign investors at all. On top of that, foreign investors who are allowed to invest in certain companies, ones which aren't necessarily as important according to the CCP, they've been banned from having any sort of voting rights. So they are allowed non-voting shares only. They're not allowed any say in how the company is run. On top of that, maximum foreign ownership of every company in the country is now capped at 30%. And on top of that, no single foreign investor can hold more than a 10% stake in any Chinese company. Each and every Chinese company wanting to list abroad, even if they are still technically allowed by these rules, they still have to be regulated by the Chinese authorities, not the authorities in the countries in which they plan to list, which is how it's done everywhere else in the world. Any company planning on listing, even if it is technically allowed by these rules, it can be instantly banned if it is deemed a national security threat by the CCP. VIEs, or variable interest entities, the system for investing in Chinese companies from abroad, is still technically allowed, but more control of this has been given to the CCP, as all VIEs will have to go through Chinese compliance. Now, all of these changes will be implemented as law on January the 1st, really quite quickly. They are not messing around here, not delaying at all. And of course, as you'd expect with this, Chinese tech stocks pretty much all fell on this news, as this is very bad news for China. It's very bad news for Chinese companies seeking capital, seeking investment and growth in the future. It's very bad for the Chinese economy as a whole as well. China's tech crackdown is clearly not over. Every other week, more people tell me that the risk is gone, the crackdown is ended, we're at the trough and it's time to buy Chinese stocks, and every single time these people are wrong. DiDi investors have been ruined by China, Baba investors, Tencent investors too. I have failed to find a single Chinese company that is actually protected from regulatory risk from the CCP, which means that there isn't a company in China that is a good investment, not a single one. Just be smart and don't bother with this stuff. There are so many YouTubers with more gusto than sense, and they're putting out videos saying that Alibaba is the best investment in the world because of a simple discounted cash flow analysis or some other valuation metric, as if they are the only people in the world who can run these DCFs. All of these people are missing the point. Every institutional investment banker and retail investor as well in the world can put data into a spreadsheet and come up with a DCF analysis that tells them that Alibaba is undervalued. These shills are all missing the point. The CCP is too dangerous, too aggressive, and too nationalistic, and that alone ruins the prospect of investing in any Chinese company. Valuation matters, yes, of course it does, but not just the cash flow, not just the revenue growth, and not just the margin growth as well, but regulatory risk. No one in the world pretends that there is no regulatory risk when it comes to Uber and ignores that when investing in the company. So why do so many people ignore the regulatory risk that comes with Alibaba when it's so much higher? Unfortunately, it actually gets worse for Chinese investors as well, as DiDi got hit directly by the CCP again. Insiders have been blocked from selling their stock. No employees at all, former or present, are allowed to sell their stock at all, with no indication of when they will be able to sell their stock if they ever can. Right now, this rule is indefinite. DiDi fell another 5% on this bad news, which is what you would expect after this. These insiders had almost reached the end of the 180-day lockup period, so insiders could have finally sold out after the IPO, but China didn't want that, so just a week before they were allowed, they banned them forever. Some specific institutions like Uber and SoftBank, who were also early investors, will be able to sell their positions on Monday, but individuals across the entire spectrum can't. Now, these firms like SoftBank and Uber, like I just said, they are expected to take heavy losses. Even though they invested in the company before it was public, they were real early investors. Once again, Chinese investments are a bad idea. There is no risk mitigation, no downside protection. The Nasdaq Golden Dragon China Index, which is an index which basically just tracks US listed firms that have Chinese exposure, so they make a lot of revenue or profits in China. Well, that index has now fallen 44% this year alone. Be smart, don't trust China. Now moving on to the US, and we see that GoDaddy, that website hoster and tech company that has had a tough year up until this point, the shares are down over 8% this year, in line with most other smaller tech companies actually. Well, they're sitting on a valuation of about $14 billion right now, and the company has really struggled to buck the trend of Nasdaq companies being overvalued and being recognized as such, causing their stock prices to fall as we head towards a more hawkish Fed, higher interest rates, and a harsher capital raising environment. Now, GoDaddy in particular has had an activist investor buy up over 6% of the company, with the intention to help improve the company and move it forward. Now, for the company, this is actually good news. Starboard Value, the investor in mention, has a history of buying into companies and helping them improve themselves, helping them raise their share prices, and they're trying to do the same with GoDaddy today. The problem is the stock has risen 20% on this news alone, and that is pretty crazy, especially considering how no changes have actually been made yet. The market is pricing this activist investor as being very successful already when they literally haven't done a single thing. This is, of course, a sign of a bubble. There is too much capital flying around, too much speculation leading to huge price increases like this, and it is entirely unsustainable. This activist investor, and all activist investors really, should just be buying up stakes of 100 random companies and claim they will improve them all, then sell out after their announcements cause prices to rise. In general, there is nothing wrong with activist investors. They provide lots of value in the markets, but this case here, this 20% rise in GoDaddy just on the news that there is an activist investor, well, it is pure unbridled speculation. Now, we got another piece of news, which might be bad news, but to be honest, it's really hard to tell how accurate or impactful this will be. But 72% of CEOs in the US are scared of being fired in 2022. They are claiming to worry about the performance of their businesses and their share prices, and 94% of them say that their corporate models need overhauling within 3 years. They're scared of supply chain shortages and labor market tightness as well. Now, of course, this is not very promising for our economies. There is a lot of worrying going on from people who have great insight into the performance of their businesses going into the future. Maybe this is nothing, maybe not. It's hard to point to this as damning evidence of anything except for the fact that there's a lot of uncertainty in the markets right now. Now, in crypto news, Binance has received approval to set up a base in Bahrain. Now, this isn't concrete yet, but they've been given this approval in principle to set up there, and there's a good chance they end up there. This would be a big win for the region and the country in particular if it comes true. It could become a center for the industry as a whole. They are still talking with and considering Dubai as well, and they're probably considering a lot of other places as well, but we will just have to wait and see to see where Binance end up. This could be the start of the next center of the DeFi world. It's going to be really interesting to watch this from my point of view at least. Now, natural gas prices are on the rise in America and elsewhere as well. This is obviously bad news as natural gas prices are already at all-time highs and it's already causing lots of energy companies to go bankrupt. Liquid natural gas is on its way from the US to Europe via huge tankers to help ease constraints over here. But with storms in the USA now and prices rising there too, there's a good chance these shipments stop and this crisis continues. This is obviously not good news for inflation. Inflation is here, it's not going away anytime soon. The transitory crowd is wrong about something once again, as energy prices are probably going to continue to spike. That is pretty much it for the day. I'm enjoying making these videos. I've seen a lot of people say that they're not sure if I'm going to continue making them into January, but I think I am, at least for the first half of the month. I've got the time right now. I'm enjoying it. I'll have to take a break around 2/3 of the way through, but other than that, I'm going to keep on going with this. Now, if you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own personal investments. And if you join before December ends, then the next month will be entirely free. This offer only stands for a couple more days. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting then make sure to check it out. There's also a link in the description to BlockFi which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support, thanks for watching, stay stoic, until next time.